Hello, this is Domenico with Easynomics, and today we're going to see a connection between what we've been learning with regard to trade protection, tariffs, quotas, and so on, and how that links to impacts on the exchange rate. This is similar to previous videos where we've looked at the impact of a change in the exchange rate or value of a currency in the foreign exchange market. In this particular video, we looked at how a depreciation of the Thai baht impacted Thai's macroeconomy in terms of creating cost push inflation, imports becoming more expensive, and imports are part of the aggregate supply curve, but how a weaker currency also leads to their exports being a cheaper alternative in the world market and could also cause aggregate demand to shift out, generating a type of demand pull inflation. So the IB would like us to see these connections between various models and how a change in one part of an economy could lead to other effects in other parts of the economy or in the global economy. To draw on a kind of real world example, there's a study done by the Bank of Canada looking at what is a theoretical impact of tariffs. And this is in the era of the Trump administration, beginning this era of trade protectionist policies. And although Canada, the United States, and Mexico are part of a free trade agreement called the North American Free Trade Agreement, the Bank of Canada wanted to do this study of what are the potential impacts of the United States imposing tariffs against Canadian goods and how would that affect their exchange rate. And in that study, which looked at when Donald Trump tweeted that he would potentially impose a tariff against Canada, they would look what would the impact be on the exchange rate in response to that tweet. And what they discovered was, here we see in their abstract kind of a summary of their study. This paper examines the conjecture that an increase in tariffs in a free-floating exchange rate system would lead to an appreciation of the local currency. Here we focus on the reaction of the exchange rate market to tweets by US President Donald Trump regarding possible tariff increases on Canadian and Mexican goods. The anticipation of trade restrictions leads to the US dollar appreciating by 0.023% and 0.051% vis-a-vis the Canadian dollar and Mexican peso within 5 minutes of the tweet. So here, even though in theory we would expect trade protection to lead to an appreciation of the domestic currency for the country that it's imposed the tariff, here in this study, they highlighted that in reality, this could actually be the case. It also mentions at the end, exchange rate appreciation may mitigate the expenditure switching intended by the protectionist policy, which is also quite interesting. So let's try to unpackage this. So here we have a model of the United States, graph A, illustrating the US national economy, and we're going to impose an applied per unit tariff. So we're looking at the consequence of a trade protectionist policy like a tariff on the exchange rate. Graph B, we're looking at the market for US dollars, and in that study it said that a trade protectionist policy in the US would lead to the appreciation of the US dollar, which would lead to a depreciation in graph C of the Canadian dollar. Okay. Trade protection is a type of policy that can be used for what we call expenditure switching. We're trying to switch domestic consumers, or in this case, US consumers. We want them to switch away from imports, perhaps Canadian goods, and buy more of the domestically produced goods, in this case, US goods. So let's graph and analyze this step by step. So here we have graph A again, the US national economy. On the y-axis, we're measuring the price of goods and services in that economy. On the x-axis, we're measuring the quantity of goods and services in that economy. We have an upward sloping supply in the domestic economy for the United States, Sd1, a downward sloping demand for domestic goods, Dd1, and we have an equilibrium where Sd1 equals Dd1, all right, at this particular point. Perhaps I can label that point A. And point A provides an equilibrium domestic price I want to, I could illustrate that here. I could state that this is the equilibrium price within the US economy. And we notice that the equilibrium price is greater than the world price. And so if the US opens up to world trade and they sign free trade agreements with Canada and Mexico, and they see that the world price in Canada and Mexico is lower, then the US would be importing those goods because they do not have the comparative advantage. So let me just take that out just to keep this simple. So the domestic price at point A is greater than the world price. So the US would import in this case. And again, this is covered in another video that just explicitly looks at tariffs. So from that equilibrium price, the quantity of demand increases to point C, while the quantity supplied by US domestic firms that don't have the comparative advantage, are not as productively efficient as perhaps Canadian or Mexican firms, they reduce their quantity supply and perhaps some of them shut down and exit the industry, leading to some levels of unemployment in that sector. But because the US is an importing country, we see that consumer surplus is maximized. So here we have this triangular area highlighting the benefit to US consumers that are able to consume goods and services at a lower world price. And because they have additional savings, they can spend that money on other parts of the US economy that can create jobs and opportunities in those sectors. But the producer surplus has been dramatically reduced. Okay, so we'll illustrate that here. Here is the reduced producer surplus. Okay. So we have the Trump administration wanting to perhaps get US consumers to buy less Canadian imported goods, perhaps less Mexican imported goods. And so they're going to apply a tariff, which shouldn't be the case because there is a free trade agreement. But in that hypothetical study, all right, so we have the US imposing that tariff. So let's go ahead and draw that. Oops. So here we have the price going up to here. So we'll put this as world price plus the tariff. So for goods that are coming into the United States, there's an applied tax. And then we can label this as the world supply curve with the tariff applied. All right. And that's going to reduce the quantity of demand from point C to point D, or from Q4 to Q3. So we have that reduction in the quantity of demand due to the higher price. And we have an increase in the quantity of supply by US domestic firms. They're able to produce more because prices are higher and they can employ more resources, land, labor, and capital. So quantity supply increases from point A to point B, or from Q1 to Q2. Okay? And that could be the Trump administration's goal. They want an increase in domestic manufacturing. More firms in the US producing goods, creating jobs in those sectors that are increasing manufacturing, but it comes at the cost of consumers paying a higher price and they have less money to spend in other parts of the US economy. This creates some tariff revenue, so we can highlight the tariff revenue. So this boxed area here highlights tax revenue being collected by the US government. We can go ahead and label that. Okay, but it creates a welfare loss of this lost consumption. Maybe I can make it a little bit darker. Here we have this lost consumption here. And we also have a welfare loss because we have increased production by productively inefficient firms. All right, so A, B, C, D, I'll label this D. This is area E, F. right? And areas D is a welfare loss due to increased output by productively inefficient firms in the United States. And also F is a welfare loss due to the lost consumption by US consumers that have to pay a higher price. They're facing a type of inflation in the economy, and they have less savings and less money to spend in other parts of the economy. But the producer surplus is increased. So here we have this increased producer surplus here. But we have the reduced consumer surplus. So we're just going to label these areas. This is a little bit of review. I'll label this area A, B, lowercase, C, D, E, F, and G. So just for review, consumer surplus with the tariff is now equal to areas A plus B. Producer surplus with the tariff is equal to areas G plus C. Then we have a welfare loss of D and F, and area E is the tariff revenue. Fine. So we've raised price with that import tariff. Potentially, we're getting this expenditure switching idea where U.S. consumers are switching away from imports and buying more domestically produced goods by those firms increasing output from point A to point B or from Q1 to Q2. What is the impact then on the exchange rate? Okay, let's keep in mind that aggregate demand, real GDP, equals consumption spending plus investment spending plus government spending plus brackets exports minus imports. And global economy in the IB is focused on this piece of real GDP, exports minus imports. So with the trade protectionist policy, what is happening to imports? Imports are being reduced. So that could reduce our trade deficit. Maybe in some countries it creates a trade surplus. So we're importing less. If we import less, then we'll be spending less of our money or trading less of our money in the foreign exchange to buy Canadian goods. So in graph B, in the market for US dollars, here we're looking at on the y-axis Canadian dollars per US dollar. If Americans are importing less, then they are supplying less of their dollars into the foreign exchange. So since they're supplying less of their dollars into the foreign exchange because they're not consuming imported goods as much from Canada, the supply of US dollars in the foreign exchange is going to decrease from S1 to S2. Okay, so the supply of US dollars is decreasing from S1 to S2, leading to a new equilibrium where the value of the dollar is now increased or has appreciated from E1 to E2. And reduction in the quantity supply and demand from Q1 to Q2. So here we have an appreciation of the US dollar. And that was what was discovered in this finding. It says here that in anticipation of a trade restriction, potential tariffs imposed on Canadian goods, let's say, that led to the US dollar appreciating, which in theory makes sense. If we're importing less, which we see here, if we're importing less, then Americans are supplying less of their dollars into the foreign exchange, leading to its appreciated value. So the value has increased from A to B. There's that appreciation of the dollar. If there is less supply of dollars going to the foreign exchange by Americans, that is a result of Americans demanding less Canadian goods. And if Americans are demanding less Canadian imports, they're going to demand less of the Canadian dollar. They're not going to supply the dollar. They're not going to supply the US dollar to buy the Canadian dollar because they're not importing as many Canadian goods and services. So in graph C in the market for Canadian dollars, the demand for Canadian dollars decreases from D3 to D4, leading to a depreciation of the Canadian currency from E3 to E4. E3 to E4, Q3 to Q4, going from point C to point D. So here we get a depreciation of the Canadian dollar. Okay, so that's what this study was discovering. Here is a nice link between what is the impact of trade protection on the value of a currency. So I'm going to just analyze each model, and then we'll just wrap up some of our thoughts on this. So here we're illustrating the consequences of a trade protections policy on exchange rates. In graph A, we're looking at the U.S. national economy with an applied tariff. Y-axis are measuring price, x-axis are measuring quantity. There's a downward sloping demand curve according to law of demand in the domestic economy for the United States, labeled Dd1, an upward sloping supply in the domestic economy of the United States, labeled Sd1, upward sloping according to the law of supply. Where Sd1 equals Dd1, it provides an equilibrium price in the U.S. domestic economy, but the U.S. opens up to trade. They're now part of the free trade agreement between Mexico and Canada called NAFTA, North American Free Trade Agreement, and they accept the world price. So price falls to PW, that increases the quantity demanded, to Q4, that decreases the quantity supplied, to Q1. So the U.S. is now importing a quantity between Q1 and Q4. Right, so here we have imports before. The Trump administration steps in, they intervene, and they want to protect the U.S. economy. They perhaps want to engage in some expenditure switching, switch U.S. spending away from imports from Canada and perhaps Mexico, and switch that spending towards U.S. domestically produced goods. So they impose a tariff, a per unit tariff, that raises the price from PW to PW plus tariff. That higher price reduces the quantity demanded from point C to D, or from Q4 to Q3. That increases the quantity supplied by domestic manufacturers from point A to B, or from Q1 to Q2, and thus that reduces imports to Q3 minus Q2. So we have imports after. Because of the reduced imports, we would expect imports to decrease. Perhaps that improves the U.S. trade deficit, or for some other countries, it might create a trade surplus. As a result of the reduced imports in graph B in the market for U.S. dollars, Americans are supplying less of their U.S. dollars into the foreign exchange. We have an initial equilibrium where supply of U.S. dollars meets the demand for U.S. dollars at point A, providing its exchange rate value at E1 with a quantity at Q1. And because Americans are importing less, that reduces the supply of dollars from S1 to S2, setting a new equilibrium at point B, and that leads to an appreciation of the US dollar. It's increased in value in the foreign exchange from E1 to E2 as a result of a reduction in the quantity supply and demand from Q1 to Q2. Because Americans are supplying less of their dollars, this is a result of them demanding less Canadian dollars because they're demanding less Canadian imports. So in graph C, in the market for Canadian dollars, there's a decrease in the demand for Canadian dollars from D3 to D4, leading to a depreciation of the Canadian dollar from E3 to E4, and also a reduction in the quantity supply and demand from Q3 to Q4. Okay, so there is a link here. Now, if the US dollar has a stronger currency, thinking in the long run, if the US has a stronger currency, a very strong currency, that's also going to cause their exports to fall. A stronger US dollar means exports are quite expensive in the world market. In addition, it should also be noted that a stronger US dollar makes their imports cheaper. Having that stronger dollar will enable Americans to buy a few more imports. The stronger dollar makes imports cheaper. And that's what this last line means here in this study by the Canadian Bank, the Bank of Canada. Exchange rate appreciation, a stronger dollar may reduce the expenditure switching. The Trump administration wants Americans to buy more domestically produced American goods. But Americans having a stronger dollar might see that imports from Canada, Mexico, Europe are actually cheaper because they have a stronger dollar. So the appreciation of the dollar created by the protectionist policy might actually reduce the intended expenditure switching that was hoped for. Okay. So that could be a kind of an evaluation of how trade protection, you can include this in your evaluation of trade protection. It reduces consumer surplus. It increases producer surplus. It creates tariff revenue for the US government. It creates welfare losses, areas D and F. It can lead to an appreciation of the US dollar. And that appreciation of the US dollar will reduce the cost of imports. You'll get less cost push inflation. It might encourage Americans to buy more imports because they have a stronger dollar. In addition, that stronger dollar comes at the cost of a weaker Canadian dollar. The Canadian dollar has depreciated. That depreciated Canadian dollar might actually make Canadian exports cheaper in the world market. So there's a lot of talking points here that you can expand from impacts of trade protection in global economics. And that's it. If you have any questions or comments, feel free to comment or put those questions in the comments below. And don't forget to subscribe and to like. Thank you so much.